Good morning, everyone.
Good morning, Fidelis.
Rosalind, if you can remove the background on that so we start. Hi, and welcome to today's session on the Inuka platform series of talks. My name is Fidelis Muyo, and I work with the Kenya Bankers Association. I hope you are all doing very well. We are very privileged to have as our speaker today, Mr. Joel Masiwe, who is a credit expert with one of the large commercial banks in Kenya by the name of Stanbic Bank. And without too much ado, I know all of us are keen as SMEs to know how we can finance our businesses and how we can attract people to invest in our businesses to ensure that it continues to grow. Let's just invite Mr. Masiwe to present what he has for us. Please introduce yourself, Mr. Masiwe, and take the floor.
Well, thank you so much, Fidelis. Thank you for having me this morning. I'm glad that I can see very many people are joining, and it's going to be a session where we interact, get to learn what business people out there do and what we as bankers are supposed to do in helping us drive the growth. So without much ado, my name is Joel Masiwe. I'm a credit specialist in the consumer and high net worth space at Stanbic Bank. I support relationship managers in structuring credit facilities for their customers, and we walk the journey with customers to ensure that they are successful in their businesses. So today's session will be in basically two parts. I won't do much of the talking. Maybe the presentation will take like 30 minutes. Then there will be the Q&A session, which will invite your questions, and the questions can also be put on the chat so that as we proceed, my colleagues from the SME side of business can also be responding. So at this point, I'll just like to share my screen so that we can start the presentation. Okay, Fidelis, let me know when you can see my screen.
Yes, we can see it.
Okay, thank you very much. Right, so I'd just like to start the session by positioning what SME is. So just like for your information, know that SMEs make up over 90% of businesses in the world and account for between 50% and 60% of total employment in Africa. If informal businesses are taken into account, SMEs would account for almost 99% of all businesses on the continent. This is according to Africa Development Bank. But 30% of small businesses fail in the first year, 80% fail in the first 3 to 5 years. Why is this? Why do SMEs fail? 30% of them in the first year and 80%, quite a big number, in the last 3 to 5 in the next 3 to 5 years. So this is a question that we should ponder about as we go along this session, and we hope that what we're going to share today will actually help us be successful employees beyond 5 years and be able to create employment and flourish. So I'll just move on, and at this point I'd just like to invite the participant to just tell me who they think an investor is. Yeah, so someone can just raise their hand, let us know where you're joining us from, and just give us your understanding of who an investor is, what you think an investor brings into the table in your business, and then perhaps we can move up from there. So Rosalind, if you can just coordinate that for us if there's any volunteer who wants to tell us what an investor is.
So we have Paul, Taivuta, and also Lucy.
I can give a own guess. An investor is a promoter.
Very, very good, Paul. Thank you for that. Anyone else?
This Ted Checker. Ted Checker, go ahead.
Hi. I venture to say an investor is someone who puts money into a business with the expectation of achieving a profit.
Very good for that answer, Paul. That is quite spot on. So yeah, I think Paul and Chege, you're correct. An investor is someone who promotes, puts in money into a business, expecting a return. So at least there's no one who has said an investor is a sponsor. We know sponsors sometimes ask for returns and they are not entitled to returns. So if fare has been eaten, we just have to move on, right? So today I'd like us to look at investment from two lenses. Yeah, investment can either be through debt or equity. Yeah, so either you have money yourself, you're able to finance your business, or you need extra money from outside to be able to finance your assets and your working capital. So we will look at it in two ways. Who are the debt providers, who are the equity providers in the market, and what do they look for? What are their characteristics? Okay. Yeah, so the investment life cycle in the SME space is broken down largely into three. There are those businesses that are in the early infancy stage. There are those that are in the growth and expansion stage, and there are those that are in the mature stage. So, and when you're at early stage, sources of capital can be through self, like I just said, can be through friends, relative. They can be angel financiers, seed funding from non-governmental organizations or government, or just individuals or entities with surplus cash. So under this stage, there's not so much complication. It's just small monies that maybe you need to start a small business. And at this stage, you don't have to be so sophisticated because you're just starting and just learning the ropes to the business. And as the business grows, you'll need to now start partnering with slightly larger type of partners like banks, financial institutions, venture capital or private equity, because this institution are able to provide larger capital and they're able to give you time to pay back. Some of them will ask for collateral, some won't. Some of them will ask for participation in your board and all that, yeah? So under growth stage, now you're starting being mature, you're starting to interact with a more sophisticated type of funding. And if you grow further now, you can actually do what we call IPO. We've seen companies like Safaricom, which other one? Big corporates do IPOs in the last 10, 20 years, just to be able to expand into new markets, be able to offer new products into the market. And so those are the three levels of our businesses. So if you look at it that way, then you'll be able to know where you are and what type of investment you need. Okay, so if I can move further, so we find out who these equity investors, what type of equity investors do we have? Yeah, so we have the angel investor. This can be an individual and a small organization which normally invests in early stage micro and SME, micro and small and medium time enterprises. The ticket sizes are relatively small. Then we also do have venture capital, which is a pooled investment vehicle that primarily invests in the capital of enterprises that are too risky for standard capital markets or banks. Then more recently, we've seen an influx of private equity type of organization. They invest in growth and mature stage and invest larger ticket sizes. It's an alternative investment class that invests in or acquires private companies that are not listed on a public stock exchange. So there are other various ones that provide equity. We have crowdfunding, we have IPOs and the likes. So if you could move to the second aspect, which is debt, which is raising capital for working capital or capital expenditure. Maybe you want to buy new machinery, you want to put up a new building. You approach financial institutions with a financial muscle and the patient capital that can allow you to expand. So this type of institutions include commercial banks, which normally finance from small to large corporate size entities. They provide both secured and unsecured loans. We also have the bond markets, which issue bonds or debentures to qualified institutional buyers or retail investors. They do this mostly on an unsecured basis. And we have the Fulizas. Yeah. So this is a fintech platform where most of us with side hustle will go and take money and pay maybe in a day or two. But this type of financing is very expensive. So it's not advisable, but if it's for a short term and you're sure of the source of repayment, then you can always tap into this because most of us will not have at the early stage, most of our companies don't have the qualifications to qualify for debt from financial institutions. So this is one of the easier ones. If you have good records, the fintechs through their algorithms will be able to allocate you a limit. The government, they do provide debt to stimulate the economy, create jobs, and just ensure that the economy is running. Okay. So let's now look at our surroundings, the environment that our businesses operate in. We have to be aware holistically what impacts us so that we're able to position ourselves ready for the investors. So under the macro space, we have to be aware of our political environment, which basically, as you've seen the last couple of weeks, really dictates how the businesses are done. There may be a slowdown, there may be renewed vigor in the economy. So politics is one of the aspects that affect how we operate. And then we have economic factors, things to do with inflation, rising prices of commodities. This will affect everyone in the same way. So we need to be aware of that. There are those social aspects that we need to be aware of. We operate in a social world, so whatever we do should not be hurting our environment and the people living in it. And then there's technology and advancement that happens on a day-to-day basis. So ensure that the business you're in is not put out of business due to technology advancement. So you need to be really aware of how the tech world is moving. Then we have the environment. Ensure that you don't pollute your environment, you are a good citizen. And then also look at the legal aspects within which you operate. So ensure that you're registered, duly registered, your business is done in a legal way, you don't involve yourself in anything that is illegal. Then we move to the industry. So you just have to be aware of the type of industry you're participating in. Is it an industry that has just started, or is it an industry that is going to die? So just look at the life cycle and know where you position yourself. Is it an industry that can be reinvented through innovation, developments, what is really needed in the industry? And also ensure that you are within the regulations of that specific industry. All the licenses are in place, all the permits are in place. So if we move on to the specific market, how do you carve out yourself? How do you ensure that you have your niche in the market? So your product has to be unique. It has to have a competitive advantage. Your negotiating power has to be very high. And mostly, if you enter into a market where the barriers of entry are very low, your competition will be very stiff, and therefore you'll not be able to have an advantage on the pricing. So the pricing will be determined mostly by your competitors, so you're not able to price so high. You need to have a stable source of suppliers. Yeah, so there's no concentration risk. If one supplier doesn't supply you, then you don't open business. So you need to look at that aspect. If you deal in commodities, if you deal in services, ensure that this is stable and sustainable. You need to understand your customers. What are their preferences? How do they want their services or goods delivered? Yeah, because the customer is always right. Look into your terms of trade with your suppliers and also with your customers. Ensure that this protects you and also protect your customers. And then obviously look at what are threatening the market, what are the risks that are present in the market, and how do you mitigate for that. Then finally, as now your business internally, ensure that you have the right resources. Your management team must be well qualified, experienced, able to take decisions. Yeah, you must have a strategy through a business plan that you follow through, and ensure that you're always guided by your strategy. Don't be all over the place. Today you start selling of chicken, tomorrow you want to start selling mobile phones. So you need to have a strategy, have a business plan that goes all the way to 5 years. Yeah. Then look at your resources. So that's what we've been talking about. And today maybe we're dealing mainly with the financial resources, but these resources from investors can be in various forms. It can be in knowledge form, it can be in finances form, human capital, and also look at the physical resources needed to successfully run your business. So these are the general things that you need to be on the lookout for, the macro, the industry, the market, and now your specific business, how now you operate within that environment. So if you're aware of those 4 things, you will be able to position your business and ready for the investor. Yeah, so this is just what I've spoken to in the last slide. There's the physical resources, human resources, intellectual resources, and financial resources. And now maybe if we delve into now what specifically investors may be looking at when now they want to put in money into your business. Same way you'll consider, say, if you want to give a friend a debt, or if you want to put your money in a specific investment. There are things that you will have to be very keen on, and some of them are highlighted here. The topic is very wide, but I just summarize some of them. So an investor will be keen on the growth prospects of the business, the competitive landscape, high barriers of entry, multiple markets and products. They look at the outlook of the industry, changing customer preferences, presence of disruptive technologies, industry growth prospects, etc. The other key thing is predictability of your earnings and expenses. Yeah, so recurring revenue opportunity and efficiency in cost management is very important. You also have to be operating within the regulations of the industry and the general government regulations, ensuring that the entity is compliant. You have to ensure that you're tax compliant, and most investors will do due diligence on this and ensure that there's no risk that will emerge after they are putting in money. And as I've said, you must have like a corporate governance. You have to have the board of directors, if at all you want to go to the higher levels, management team, and a well-experienced staff. So all these aspects and many more are some of the key things that investors will be able to look at, and ensure that your data storage is clear, audit trail is there, and something that someone from outside can really place reliance on. So your accuracy in keeping data is very important. So if you look at the 2 aspects of investment, there's debt, there is equity. So just to compare the 2 in the following aspects. So we have ownership. So when someone invests as a debtor or as a creditor into your business, you normally don't dilute your ownership, because you have to repay this debt under specific terms. And once you repay, you're done with that debt. But someone who invests in your business as an equity partner, will dilute your ownership because they'll ask for shareholding, they'll ask to be enjoined in decision-making. So you need to be aware of that aspect of ownership. Management influence. Under debt, there will be none unless some special conditions have been agreed on. Equity shareholders will have a voting rights along with rights to board representation. Repayment. Debt has a maturity date, stock has no maturity date. Other obligations, payment of interest and repayment of principal according to fixed schedule. Under equity, there is no obligation of paying back the debt, but you participate in profits and you also participate in losses. Claims on income and assets, debt is senior to equity. Equity is subordinate to debt. So if anything happens, you first pay your creditors, then the shareholders will be the last to recover the investment if at all. Collateral, debt is mostly collateral dependent. Equity will normally ask for no collateral. Cost, the general cost of debt is cheaper as they have priority in repayment over equity shareholders. Generally, the cost of equity in proportion to risk return profile of the company, as equity investors have residual interest in the company. And the tax benefits, tax shield on interest payments. Equity, basically there are no tax benefits, right? So I'd just like to pause at this stage and maybe invite some observation reactions as I leave you with this quote. If we can't respect the way we earn it, money has no value. If we can't use it to make life better for our families and loved ones, money has no purpose. So I'd just like to give it back to Fidelis and just invite some comments from the participants and any question maybe, so that we can move on to the next stage. Thank you.
Thank you very much, Joel. I think we have benefited a bit more than we bargained for in terms of our expectations in the talk, but it's very good because that means you actually have presented a wealth of experience to prepare this. What I saw during the discussion is somebody who mentioned where we can get angel investors. They were asking where we can get these investors. So maybe we can see, is there any place where platforms, people can see you to attract investors? And then somebody else was talking about negotiation powers. I think that one we can discuss later on in the Q&A, but maybe you can tell us where investors can be found. So if I'm looking for an investor, how do I start?
Yeah, so thank you very much. So angel investor can be anyone. It can be an individual, it can be a non-governmental organization that has specific interest to provide impact in a certain segment. Yeah, it could be education, it could be uplifting people who are disadvantaged in the society. So it can be your relative. They can be having excess funds, and maybe they won't give you very tight terms and conditions to repay. They're mostly there to support you, to bring you at a level that is better or provide impact in the space that you're playing in. So the various we can provide a list of the angel investors that are existing in the Kenyan market. We can share that in this chat. You can share email addresses for the participants, and then maybe later on we can share the specific portals that people can look at if they're looking at specifically angel investors. But angel investor is a name that is given to people who will give you money, and they won't be very strict on repayment, and they're basically giving you to uplift or support you to come out of a disadvantaged position.
Okay. The other one was Rose, who is asking between debt and equity for a small SME, which one is better?
Okay, when you're starting, it's always good to get equity. If not, you can deal with quasi equity where the person providing debt is not too strict as a normal lender will be. So they will maybe give you debt at very concessionary terms, cognizant of the stage of maturity of your business. So debt, it has no cost, because maybe when you're starting, the establishment costs have been very high. So if you put in cost of finance, maybe you'll not be able to provide your services or goods at a very competitive rate. So at this stage, maybe you just try and minimize your costs. And then as you grow, maybe now you can start introducing the cost of finance through debt that are really structured to your level of growth and to actually what is needed. If it's working capital, if it's asset finance, if it's a business expansion, that has to be matched specifically to what you need so that you don't find yourself in an overborrowing position and then you're not able to compete well with within your market. So debt will be preferable at that stage, or equity will be preferable at that stage, or debt that is very concessionary and patient. So that's what I can say with regard to that question.
Thank you very much. And I think with that, maybe we can then move to the next section of your presentation, and thereafter we can take a bit more detailed question and answer session after the second session.
Thank you very much. So at this stage, maybe it will be a bit different. So we'll look into the numbers, yeah, but not to a very detailed level, just high level on what debt and equity partners will look at, because they look at the same things, whether you're putting in debt or equity because you want to get some return. There are some specific numbers that these people will be keen on. And this is sort of a scorecard for a business. Yeah. So the next session is just to make us aware of what is important from an investor's perspective with regard to numbers. So as you run your business or on a day-to-day basis, you need to be cognizant of how your revenues are generated, how your customers pay you, what modes of payments are available, the terms of payment, how do you deliver the goods and services to them. All this have to be clearly mapped out. And this is an aspect that you should be able to articulate to investors, because that's where everything starts. Everyone wants to do business for profit. And how are you operating your day-to-day activities to ensure that you are turning around a business to bring in profit? So you're supposed to be able to manage your liquidity and cash flow requirements, ensure that your business is not cash strapped. You're not able to pay for obligations as and when they fall due. You should be able to negotiate with your suppliers, negotiate with your customers on credit days, ensure that your creditor gives you days to repay, which accommodates the customers. Yeah, so you only will be able to pay for the suppliers if you receive money from your customers. So you should be very careful on your negotiation terms with your creditors and the kind of credit you want to extend to your customers. So how will you be able to do this? You need to be able to optimize your ecosystem. Your ecosystem will be your employees, your shareholders, your contractors, your suppliers, yeah, your regulation authorities. All that is the ecosystem. So look at how you're able to optimize on that and run a successful business. So when we talk about income, the investors will normally ask for a document called the income statement. So this itemizes incomes against expenses, and the intention of any business is to have more income than expenses. So if you have more income than expense, of course, you will be returning a profit. But just how do we ensure we are returning a profit, even in the challenging environment that we have seen in the recent past? There have been very high inflation there have been COVID period where most of the things came to a halt. How do you now ensure that you're still alive, you don't go under? So some of the aspects that you should look at are your expenses. You should be able to control your expenses. A smaller portion of your expenses should be fixed, and a higher portion of your expenses should be variable. This then ensures that should anything happen, say that there's a slowdown in the economy, you're able to quickly bring down your expenses. But there are some expenses that will remain fixed, like rent, if at all, insurance for that property. Some of those expenses will remain constant, but ensure that that ratio of fixed to variable should be the higher type of expense, because this allows you now to be flexible and still remain profitable. Ensure that your sales are completed, your customers are satisfied. Look at other ways to diversify your income. If you have excess cash, how else do you invest it to ensure that your cash doesn't lie idle in the bank? You can decide to put it in a fixed deposit, put it in government bonds, invest in a property that will also give you rental income. The diversification of income also ensures that you don't get impacted by sudden shocks in the economy, right? So when we look at cash flow, this is basically the oil that greases our businesses. It's the first fundamental rule of doing business. We have to ensure a company generates the needed cash to pay for fixed and variable expenses while still turning a profit. Okay, so we sometimes see that companies have a lot of money in the bank account, but when we look at their profitability, we tend to find that these companies are not making any profits. So just like to pause at that and maybe just ask for a volunteer to tell us, how is it that a company can have money in the bank, but when you review their financial statements, they are loss-making? Any volunteer can just tell us how that situation can come to be, and then maybe we can take it up from there. Rosaline, if you can help with that.
I've enabled David, who has his hand up to say something.
Yes, David, please say.
Not David, we can move to Dr. William.
Hi, everyone. Hello.
Hi, Dr. William.
How are you?
Very well, thank you.
To the question, direct to the question that you've asked.
Yes.
When the money that comes in is too little, but maybe you have 100,000, but you spend a lot on it, and the period that the next money that is being deposited is like takes another 15 days for you to get another money. That one you'll identify that the company get some losses when the expenditure is so high and the money is the income is too low.
Yeah, spot on. That's very correct. Any other volunteer?
Yeah, somebody had put on the chat about low margins. Yes?
Mm-hmm. Yeah, great, that's true. All right, so maybe if we can just also wrap it up. So as I've alluded to in the previous slide, we have people who supply you raw materials or services, which then you convert into products that you sell. So in normal business, maybe a supplier will give you 30 days, 60 days to pay. You on the other side will give your customers 30 days to pay. right? So at the financial year end, even though you might be holding money that is supposed to be paid to a supplier, because the supplier gives you 90 days to pay, your bank account might appear to have cash, but once you make those payments, just due to low margins and high expenses, you end up being loss-making. Because a financial statement, the income statement is prepared on a 12-month basis, and it's done on an accrual basis. Yeah, so it won't be specifically on the cash that you have at hand, but now it will be on the level of income, the level of margin, that now that profit will be recorded or reported. So that's the aspect I wanted to bring in, even as we move into the next slide, which is what is the working capital cycle. This is the heartbeat of a business. So if you can understand this, then it will be very easy for you to compete, to position yourself very well for investors. So how does cash move from being cash back to being cash? Yeah, so you have cash, you've decided I'll participate in an industry of buying, let's say, mobile phones, all right? And then maybe you do some upgrades on the mobile phone, you sell it, you give your debtor some days to pay, and then you make a profit, yeah? So you start from the level of, you have to have cash. So this cash at the starting point is the capital, which can either be debt or equity. Yeah, you use this to purchase stock. How long do you stay with this stock? How long are you able to turn it around to the final product? So once you've purchased the stock, maybe your supplier will give you days to pay, 90, 30, because you have to convert, or you have to do marketing for these products to be sold. So you need to negotiate for terms that will be able to cover you during that period, all right? So you have to have it as stock, raw material, work in progress. Maybe you need to convert it into a finished product. Then you need to distribute this product to the market. So that's the sales part. And maybe due to the competition, you're forced to extend credit to your debtors, maybe 30 days or 60 days, so that you're able to attract more customers. So you have to balance the days that you're holding stock, the days that your supplier gives you to pay the creditor days, and the days that you give your debtors to pay you back. Yeah, so this number is what determines your working capital. So say, for instance, you hold stock for 30 days, your debtors takes 30 days to pay you, and your supplier asks for 90 days to pay. Yeah, so you need to add the stock days, which is 30, debtor days, which is 30, and minus the 90 days that your supplier gives you. So in total, you'll have 30 days with the creditor's money. So the creditor has actually extended you his money at no interest for 30 days. But if it's the other way around, let's say you stay with your stock for 60 days, the debtors take another 60 days to pay you, but the supplier gives you 90 days. That means you will be out of money for a period of 30 days. So you need to come to a different type of lender. So the supplier has already given you the 90 days, but they're not enough. So you need like an overdraft from a bank or another lender to be able to sustain yourself for the 30 days. So this is a very important aspect to ensure that your business stays afloat. You're able to meet your short-term obligations as and when they fall due, and you're still able to turn a profit. All right. And then we need to be able to distinguish between capital expenditure and operating expenditure. Yeah. So when you have cash and you have to make a payment towards purchase of stock that you need then to sell, or you have to pay for transport, all that will be categorized under operating expenditure, and these are normally expensed within the year. But if you're looking at expanding your business, maybe adding a fleet to your business, this type of expenditure will be called asset acquisition, and it's called capital expenditure, and mostly it will take time to recover. So we are allowed to expense this type of expenditure through what we call depreciation for the tangible assets, or amortization for the non-tangible assets. Yeah, so we need to be able to understand that aspect if you're looking to get financing for capital expenditure or get financing for working capital, which is the operating expenditure. So as we finish, so some of the things that we look at as capital providers, either debt or equity, when you give us your financial statements, we want to first see that you're liquid, because liquidity is what will pay the debt, it's what will pay the dividends. And a quick way to look at whether a business is liquid is to look at their current assets and current liabilities. Yeah, so this will ensure that their ability to meet short-term obligations efficiently and generate revenue is okay. So the number that you get when you divide current liabilities over current assets should be more than 1. Yeah, so this means that people who owe you money will more than cover the people who you owe money. Okay. Then the other aspect that we'll then look at is profitability, which is the ability to generate financial success to help attract and retain financing. So we'll be able to look at ratios like the gross profit over total sales and compare that to other players in your field. Are you remaining with adequate margins, or are your margins slimmer, or are they more than the market? What are the outliers? We then move further down to the net profit after deducting the normal overheads, which are the salaries, administration costs. What then are you left with? And then we compare that also with the industry average and see whether you're within or you're an outlier, and what is it that you're doing differently from the market. Okay, and that's just what we've spoken about in the last slide, is basically efficiency, how efficiently the business resources that have been generated have been used towards financial rewards. Yeah, so you have to ensure that your debtor days are less than your creditor days. Yes, because that means that then means that you're able to get financing from your suppliers. Yeah, so if it's the other way around, then you'll be forced to incur finance costs, which now will add maybe into the pricing that you're offering the market. Then we also look at whether, when we want to get into the relationship, whether you're a solvent entity. Yeah, so solvency is reviewed from the balance sheet, and balance sheet is basically a simple equation. If you want to start a business, that means you want to buy assets. How do you then fund the assets? So we've spoken about debt and equity. So balance sheet basically tells us how your assets have been financed. Has it been financed more from a debt perspective or from an equity perspective? So the businesses which have more equity than debt will be able to compete better. So we will be more inclined, but we can always look at this from an industry perspective. Is a specific entity borrowing more than it should? Is it over borrowing? How then is it able to pay back the debt? So those are the 4 main ways we look at businesses when we want to invest in them or support them through lending. All right, so that was the second bit. I hope that has helped us just to understand how we are scored by investors. I'd just like to stop it at that and now maybe go into the question and answer session. I'm joined by my colleagues from the SME Direct Enterprise team, who will also be at hand to answer the more specific questions. And I'd just like to thank you for your attention and for the participation. Thank you very much, and back to you, Fidelis.
Very, very great presentation. Thank you very much, Joel. And I believe we have all learned a lot today in the short period that you have actually been talking to us. I've seen a few questions on the chat, and to manage the process, what I'll ask is that you raise your hand so that we can then see who it is who has a question, and then we will select you to either speak to the question. Then if you don't want to raise your hand, you can actually type in the chat the question, and I'm looking at them, and I'll be then able to take them up. Rosalind, do we have some people? I see 3 participants have raised their hands.
Thanks, Fidelis. I've allowed Lucy to post a question.
Okay, Lucy, please state your business and then your question quickly so that we spend as little time as possible. Is Lucy still there?
Yes, she is. She's unmuted herself. Go ahead, Lucy.
Oh.
She's also has her on the chat. We can read it out from there.
Okay. Maybe you can read the question instead then. That way we'll just move.
No problem.
Bernard is stranded on how to approach banks for a financial boost as he wants to start a charcoal briquette job. I don't know whether you can take that.
I will attempt, and if any of my colleagues also want to add on, they're more than welcome. So basically, if it's a startup, as we've said, you must have a good business plan, which also have some type of workings, projections, what type of market are you targeting, the price entry that you're looking at, and basically you have to understand what type of financing you're looking for. So that has to be summarized very well in a business plan. We need to be able to see that you've done your research, you understand the market, and you're also willing to put some money into the business. So the bank will come in, but normally would not like to fund 100%. We also like you to put in some equity so that we can generate, so that the risk is shared between yourself and ourselves. If you already have experience, maybe we financed other people in the bank doing the same business, we should be able to share some of our experience with you. So I don't know whether there's anyone from Stanbic team who also wants to add on to that. Thank you.
Okay, I don't see anybody from Stanbic, so maybe we can discuss another one. There's somebody who had asked about a benchmark net profit margin that would entice an investor. So if I'm delivering on my business, I have some profitability, what would be a ballpark figure that most investors would want to be attracted in my business?
That's a great question. And that's the way to think. No, so now if you want to look at an investment from a debt perspective or an equity perspective, maybe someone wants to put in equity, is looking for a return of 20%. Say maybe they don't want to put money in the savings account, which gives 10%. So they are willing to take risk so that they get more return. Because we say higher return, more risk, you get higher return. So if they put money into your business and say the banks are offering returns of 10%, which are basically very low risk, they of course want to make more money than that. So an equity partner who will be sharing in dividends will want to be able to have a return that is basically higher than the general interest rates in the market. If it's someone who's giving you debt, they want to be able to see that your profits or your operating profits will be adequate to repay the interests and the principal component of the debt. So that's how we look at it from a perspective of investments or equity or debt. I hope that answers.
Yes, actually that does answer. Can we take another question, Rosalind, from somebody else?
Yes, there's a question from Margaret Waweru. She's asking, please revisit the issue of stocks and credit terms.
Oh, okay, maybe Joel, you could just explain that structure of the dynamics of the aging of your credit terms and the aging of your stock holding. I remember, yeah, that one, yeah.
Yeah. So this it's basically called the working capital cycle. Yeah. So depending on in the industry that you are in, maybe you are in a business that you just have to import goods from China. There's a period of shipping them to Kenya, when there's a period that you need to now store them and actually distribute them to the market. So you have to ensure that if you have a supplier offshore, if possible, they should be able to cover you to be able to ship the goods and also be able to sell the goods before asking for payment. Yeah. And if possible, they should also cover you for the credit terms that you're giving most of your suppliers. But if you're selling cash, then you don't have to ask for more days. So just ask for the period that will cover you for shipping and distribution. Yeah. So that will enable you not to go to banks to now ask for money to pay your supplier. And that minimizes your costs of operation.
Okay. Great, I think that's it. There's somebody who had said you kindly replay the last slide, the final slide. I don't know which that final slide is, maybe the one. Yeah, I think that one.
Yes. So basically, as we've just spoken about, these are the key metrics. Maybe you can take a photo and maybe go back and just research on them and how maybe your business is faring with regard to the four aspects. And in case of any questions, you can always contact us. We will leave our contacts so that you're able to reach out on us. And there's a great ICB team at the branch networks that you can approach so that you can be able to understand deeper these aspects of economic drivers.
All right. Somebody had earlier asked, why do banks not play in the venture capital space? Maybe you could address that.
Yeah. So banks are regulated by Central Bank of Kenya. We lend money that you same customers give us. So we need to be able to lend in a responsible way, in a way that is in keeping with the regulations of Central Bank of Kenya. And that might not really be in conformity with what other venture capitalists do, because we have some ratios that we have to meet. We have the loan deposit ratios, liquidity ratios that are some of the parameters that or the banks are assessed against. But we do partner with development finance institutions. We do partner with the government of Kenya through the credit guarantee schemes to be able to compete in the space, in the venture capitalist space, so that we're able to stimulate the economy and offer solutions to our SMEs who are up and coming.
All right. I don't see any other new question, and I don't know. Rosalind, can we take another, maybe 2 questions or so?
Yes, we can.
Okay. Anybody have any questions either on the chat or by raising your hand?
There's a gentleman by the name of Gideon who's asking how can he access funds for his youth project from a banking institution? What are the requirements?
Youth projects. Okay. The youth projects are normally government-run projects. I think there's the Youth Enterprise Fund. I also think there's the Women Enterprise Fund. So maybe what that person would best be served is to go to the Youth Enterprise Fund website, and they'll then be told which banks then partner with the Youth Enterprise Fund for whatever kind of business they are doing. So maybe that might not be for this discussion, and maybe if they approach the Youth Enterprise Fund or the Women Enterprise Fund, they'll be able to be guided to which banks are partnering there. All right, there's another question I had myself in terms of general guidance, Joel. This is your personal view. I remember the beginning of the process, you said most SMEs fail within 30 or the first 30% within the first year. And seeing a lot of us are already here, that means we have beaten the first year, but within 3 to 5 years, another 80% fails. So in your view, what would you advise an SME that is within the 3-year to 5-year period? What should they do to avoid failures? In other words, what are the biggest causes of those SME failures?
Right, thank you so much, Fidelis, for that question. So there's data on reasons why most of these SMEs fail. So maybe if I can just summarize why they failed, so maybe we'll do the opposite. So we look at most of them and we see there's a lack of planning. There are no proper strategies, no records to guide them in terms of strategy. Proper management of the business is lacking. A lack of skills that will enable them to compete with other players in the market. Some of them will be borrowing more than you need. Then there'll be some people issues. Most of this will be family type of business, and when they're introducing other people, maybe there will be some conflict or just a conflict within families. Maybe the business will just not be performing. They're not aggressive in what they promised. Then there's a sustainability, whether the business is sustainable. Maybe it was just a bubble, or it was just a seasonal business and you still feel like you want to proceed, and maybe you're not dynamic enough to change with the times. And the bigger challenge is the collateral adequacy. Most of the SMEs will not have sufficient collateral to enable them to approach other type of investors, including banks, which can then give more financing to enable them advance. And just having a business that is not rigid enough, maybe fragile in terms of controls, and gives way to fraud and mismanagement. So those are some of the things that we need to look at and ensure we don't make those mistakes.
Yes, thank you very much, Joel. I would like also to add a bit on those. There are the very small MSMEs where maybe somebody has just started on their business and they are using their finances to then finance the business. One of the biggest mistakes I've seen a number of them do is that they do not separate their personal finances from the business finances. So sometimes somebody is running the business and is using their own cash, but then they also, when they sell, they then use that cash for their own personal expenses. Some of them end up eating the stock, and then they can't then sell and return the business to where it was before they actually did the sales. So it's a very important thing to separate your personal expenses from your business expenses so that you can be able to track how your business is doing vis-a-vis your personal expenses, and maybe you then run it like a business, even if it is you yourself. You make sure you pay yourself a salary. You do not touch any money that you made sales from unless it is the money that you allocated for your salary. That way, then you don't run out of cash when you need it.
Thank you. Thank you very much. That's a very common problem, and you've articulated it very well. So we need to be cognizant of that fact of separating our personal money, our earnings from the cash flow of the business, and that will enable us to prosper. Thank you very much for that observation and response.
Well, I think we are almost on 10 o'clock and I don't see any other questions. So maybe we can give somebody an opportunity for one final round of questions. Rosalind, maybe we take two questions and then we can close the session.
Thanks, Fidelis. I don't see any new questions. Just request for the recording and the slides, which we'll share after this session.
Yes, because everybody who registered, you left your email address. We will give you links to the recordings and the slides so that you can then reflect on them later on at your own time and maybe revise some of the things that may have passed you over. And I think it was a very well attended session. I can see it was very good attendance and I hope everybody then benefited from the hour. Let me take this opportunity to thank you very much, Joel, and your team behind there. I know they took time to prepare the slides and enable us to then learn a lot from you. I would also like to thank Stanbic Bank for the support they are giving us in terms of allowing you to make this presentation. And for the participants, thank you for sparing the time. I hope it was a very good 1 hour invested. And in the event that you want, we've seen a few ideas, especially for negotiations. Maybe somebody requested whether we can help them in developing negotiation skills. Maybe, Rosalind, we can structure a session where we can get somebody to come and advise the SMEs on how to negotiate and how to structure deals so that they can be able to be empowered to negotiate deals that are favorable to their business.
Absolutely.
All right. Thank you very much, everybody. And then I'll hand it over back to Rosalind to make her final closing remarks and we close the session.
Thank you so much, Fidelis. Thank you everyone for making the time to be part of this session. Remember, we hold these sessions on a monthly basis and we hope to see you soon. Thank you and have a good day.
Okay, good day, everyone.
Yeah.